Welcome to the Maine Real Estate Roundtable podcast. I'm Bobby Grenier, your trusted guide to navigating the world of real estate in Maine. Get ready to debunk mortgage myths, unravel real estate mysteries, and learn tips to avoid costly mistakes. Whether you're an industry pro, an overwhelmed buyer, confused seller, or simply curious about life in Maine, this is the podcast for you. Hey there, you have found the Maine Real Estate Roundtable podcast. I'm your host, Bobby, and this is a podcast where we talk about all things Maine real estate. I'm very excited to bring back second-time podcast guest, Mark Lloyd, loan officer with Total Mortgage, and he is sharing with us some great tips and strategies on building, repairing, and maintaining our credit scores. So let's jump in. Hey, good morning, Mark.
Hello.
Welcome back. Second time podcast guest. I appreciate you coming back. We had a great chat, and that was episode 36. And we were talking about Maine State Housing Authority. There's so much great information on that episode, so I definitely want to point people back to that. But as we were talking earlier, in that episode, you really got into some great information about credit scores. And then we talked later and decided that that needed to be an episode all on its own. So I've welcomed you back, and I appreciate you taking the time to come back and talk with us all about credit scores. And we're going to cover the basics. So this would be a great episode for younger people, college students, or even high school students. And I think that sort of the theme, and you can correct me or add to it, but the theme of this is about preparation and not trying to figure out that credit score piece when you're applying for the loan. But I really want to start just at the beginning, at the basics about what is a credit score?
Yeah, so basically you have your credit score is going to be broken up into, a bunch of different pieces. Paying your bills on time, that's like 35%. Reducing your credit utilization is like another 30%. Then out of that, then you have like 10% of your score is like hard inquiries. Another 15% is like old accounts. Also, I'll get into this more further, but one of the mistakes I see a lot of people do, they'll pay off their credit cards and get excited and they close it out, and now you've defeated the whole purpose because now you've lost all those trade lines. If you pay off your credit cards, you want to leave them open.
Yeah, that's actually a really great point. So I'm going to have a confession here with you for a moment that I really didn't know what FICO stood for. I Googled it before we got on this talk because I didn't want to look dumb in front of Mark. Explain if there is any difference between a FICO score and a credit score.
Yeah, so I mean, there's different types of bureaus. So like kind of dive into like Credit Karma. This comes in a lot, where people will go ahead and they'll go on Credit Karma and they'll say, "Hey, I'm a 720," and and then I pull their score and they're like a 670, and they get frustrated. And so Credit Karma uses like Vantage Score 3.0, whereas we use a FICO score, usually the 2405, some of the older models. And so we pull from the three bureaus, so Experian, Equifax, and TransUnion. Credit Karma, on the other hand, they only pull from Equifax and TransUnion. So like when you pull a score, we do three scores and say you're a 650, 675, and a 700, you're going to be the 675. So if there's three, we're going to take the middle score. If there's two, we're going to take the lowest score. So what happens sometimes, people will look at their Credit Karma and they might say that they're a 675 and a 720, and they're just going to say they're a 720. And that just isn't really how it's going to work. So we have the options now to do like a soft pull, which will let you go ahead and, be more proactive. But like I said, the biggest thing is, you have Vantage scores, what Credit Karma uses, and we use FICO. So like the only way that you can get your true score as a consumer is if you go to myfico.com, and then you can click on the mortgage option and you can actually get your actual score.
But before we go further, can you give us just a little more of a description and the difference between a soft credit pull and a hard credit pull, and what to what to watch for if somebody is going to do a hard credit pull when maybe you're not at that point to do that?
Right, yeah. So your soft pull doesn't impact your credit, whereas a hard pull will. The soft pull will give like basically the same information. It's just that if you were to go under contract, we then do have to do the hard pull. The the soft pull is basically it's going to give you all the information, so you can come up with a game plan and not affect your credit. Whereas the hard pull, that's going to affect your credit because also so when I do pull your credit, it's going to show your inquiries. So if all of a sudden you've got, say it's around Christmas time and you've said yes to some of these stores to save 5-10%, now your score is going to sometimes drop 20 points because you've applied for all these credit cards. And the other thing you need to be aware of before you have the conversation with your lender, before they pull their credit, because you're also going to potentially get what's called trigger lead calls. So like myself or any lender, we do not sell your information. However, once we pull the credit, the actual credit bureaus do start selling off your information. So that's your Experian, Equifax, TransUnion will sell it. And the only way to stop that is you can do the www.optoutprescreen.com, and that will hopefully get you, but it takes a few days to help you to get that. Because what will happen is your credit gets pulled, and you'll start getting phone calls from all these different companies. And it's not just mortgage. The same thing if you apply for a credit card, you apply for getting a car loan, you're going to start getting all these calls. So that's something else you want to be aware of when you do the hard pull. With the soft pull, that's not going to happen.
Do you feel like it's becoming the industry standard with loan officers? Because people do, as consumers should, shop around, talk to different loan officers, see, I mean, rates are pretty standardized, but what rates may be, who they are comfortable with, what programs that particular lender offers. So, for the most part, are you finding that loan officers will utilize that soft credit pull as opposed to sort of roping them in because now they've done a hard credit pull, so maybe they feel like they need to stay with that lender?
Yeah, it's kind of a mixed bag. So it depends on if like if they're like basically, hey, I want to put an offer on this house today, they're very serious, then I'm gonna more apt to do the hard pull. If they're like, hey, I just kind of see where I'm at, I'm maybe thinking 6 months down the road, stuff like that, then I'm going to just do the soft pull. Obviously now if they request a soft pull, you're gonna do the soft pull anyways. Because the other thing, if it's further down the road, the credit score is only good for 120 days. Which means we have to close within that 120 days. So like I said, if they're saying they're looking at 6 to 12 months out, we're going to do a soft pull regardless, just because it's no sense to do the hard pull.
Can we talk about like the actual numbers as to what is a low credit score, what is exceptional credit? Can you give us the range?
Yeah, so I mean, you're with mortgages and credit cards, it taps out at an 850, whereas automobiles are at a 900. So that's why sometimes people's scores be a little bit different when they go buy a vehicle. So your minimum is 580 for FHA and VA. Now, 580 is not desirable. Anything above 780 is premium pricing, meaning you don't have any loan level price adjustments. So it's not costing you any money on your rate. Whereas if you are 680, it might cost you more to get your rate. So it's just gonna, and also that's gonna affect your different loan programs. But basically, above 700, we're gonna put you into basically any loan program we can. If you're the 600 to 700, we're gonna be limited on what we can put you in.
So having a higher credit score not only is a good thing, it makes you more credit worthy, but it can actually save you money on that loan product when it comes time to get your mortgage.
Oh yeah, it can greatly, because like I said, if you get into a main state housing, that's going to save you money on no points, on your rate, and give you money. Or if it's just going to be a situation where now you can get into a conventional loan where you don't have any upfront fees, which you might have with some other like with an FHA program. So it's going to save you money the better your credit score is.
This may sound like a sort of an elementary question, but again, I'm really hoping that a lot of young people listen to this episode. Why does it matter? What does that credit score say to you as a lender?
So everything is risk based. So if we're looking at it and it stands for, their ability to repay this money. If I'm looking at somebody and, they're a 580 and it's because they have missed a couple of payments, that okay, that's maybe ask why, what's going on. Sometimes with stuff like, hey, I was going through a divorce, it was COVID. I mean, different things. Sometimes that people have reasons why. You can look at it if all of a sudden when you look at credit report, why is it these 2 months, all of a sudden they had a couple late payments, whereas before they had nothing. So you kind of dig deep into it and just kind of work, try to figure out what's going on. So you're like, okay, this isn't as bad as it looks.
Before we jump in, I know you've got some great strategies and tips for us. But before we do that, I just want to touch on one thing that you probably see all the time is people don't want to be judged on their credit score as a person. For people that are, older, that have lived some life and life happens, loan officers are there to help, not judge, right? I listen, not judge. Isn't that the trend now?
Yeah, yeah, and again, everything's different. So you also there's other reasons why people might have a low credit score. Sometimes they have a low credit score just because they pay cash for everything. They've heard the horror stories of credit, or it's a situation where maybe somebody's in their 50s or 60s, in their 30s they racked up a bunch of debt. They ended up doing a debt consolidation, and they're like, I'm never gonna have a credit card again. So after time, your trade lines drop off. If you don't have anything active, and so that's when you sometimes getting like non-traditional credit strategies if somebody doesn't have a credit score. So there's a lot of different reasons why somebody might not have a good credit score or a credit score at all.
Well, the good news is that you and I are here to help. So, what I want to talk about first is building credit. And I know you've got some great strategies for us, so I'm going to let you start with the first one.
Yeah, so like key strategies for improving your credit score. I touched on it in the very beginning, but pay your bills on time. That's going to be 35% of your score. So like timely payments are definitely crucial to maintaining your high credit score. You can set up auto pay, for your credit cards, loans, and bills, because one late payment can negatively impact you. So you want to always, make sure your stuff's paid on time. And then also like, so if you say you set up an auto payment, verify how much your payment's going to be. Because say it's a Lowe's and you're like, I'm gonna set it for $100 a month. Well, say now your dishwasher went, now you bought something else, and now your minimum payment is 115. Well, you want to make sure that you're at least covering your minimum payment if you are doing your auto pays. Then one of your, next steps is a big thing is reducing your credit utilization, which is another big factor. Is 30% of your score. So what that's going to be is, you have $1,000 limit and you have $900 on it. Well, that's going to basically almost show you as like a late payment, as far as affecting your score because you got such a high utilization. So you want to drop that. They always say 30%, but it's really more like 10%.
You know what? Sorry to interrupt, but I have
Yeah.
a question on that. I am one of these people, and I have a credit card that I buy everything on and I pay it off every month. But it appears to have a high balance. Well, it does have a high balance, but I pay it off every month and they keep increasing the limit, which I guess helps me because then I'm not using as much of a percentage of the available credit. What would you caution me on that, or is that an okay thing?
Yeah, actually, that really was my next topic was the, increasing your credit limits. But the big thing on that is because I see it a lot. People will tell me, they've got a $5,000 credit card and they put anywhere from 3,000 to 4,500 plus on it every month, like say for work, and they get reimbursed. I always tell people like, so if your score, I mean, if your statement comes out on like the 25th, then make your payment on the 20th. Make your payment ahead of time because what goes to credit is what's on your statement. So that's what sometimes gets people in trouble is like every month, they're paying it off. But the credit bureau doesn't know that. All they know is what's on the statement. So you want to go ahead and make your payments ahead of time. And I mean, I know some people that literally make their payments every week. And then the other thing with that, you kind of touched upon, like, they increase your limits. So if they want to increase your limits, I always tell people that, always let them increase your limits, unless, of course, you just don't trust yourself. That, like, you're like, oh, I only have this $500, but in limit, but I know if they give me 1,500, I'm going to go spend it. Then obviously, if you know that, then don't do it. But having a higher credit limit, not only does it reduce your ratio, like, so if you're, $1,000 limit, or say your $500 limit and you have $500 on it, you're maxed out. You get 1,000. Well, now you're at 50%. You've already cut it that in half. But not only does it help you on that credit card, it can also increase your overall utilization. So if you have other credit cards that maybe they're at like 60%, but you have a couple other credit cards that are, at 0% or lower, you also will take the totality of it. So that also helps you out in the long run if you have more available credit that you're not using.
That's interesting. I didn't realize that because I know for me, most of us have that one favorite credit card that we use, pay it off every month or
Yeah,
however we decide to manage that. But you usually have a few other backups just in case. So that's actually something I've just learned. That's a good point.
yeah, and so then when you go into debt, then also so you're gonna have like a debt payoff strategy. So it's a couple different ways that you use with the debt avalanche method is basically you paying off your high interest debts first. That's that's sometimes help you out because now you're going to be saving the most money. But then there's also like the debt snowball method, which focuses on pay off smaller debts to start gaining momentum. So basically, you might have that credit card that's at which some actually are 30% or more now. You might want to just target paying that off. It's helping you out every month. But when you're looking at it, sometimes people feel like they're not really gaining anything. Whereas if you do like the alternate method of the snowball method, that's going to be when you might have a couple credit cards that have $1,000 limit or a $1,500 limit. So you start paying those off. It's not going to maybe have like the biggest amount as far as the monthly debt reduction, but you're going to be looking at it like, okay, I've already paid off 3 credit cards. Now I can start working on the next one. So that's kind of how that part goes. And then also sometimes, especially if I got somebody we're worried about debt to income ratios, also look at, well, which credit card has the highest payment too. Because you might have a credit card that only has a $2,500 balance, but it's got a $200 payment. Whereas you have another credit card that's got 5,000 and that payment's only 100. So sometimes we'll, depending on how much time we have, that's something we might look at to try to, for DTI as well to help, get you more qualified.
So, what else can we do to help build our credit?
Yeah. So, I mean, again, I touched on it last time briefly, but becoming an authorized user. This is, asking a family member, trusted friend that with good credit to help you, raise your score. So this is one of the fastest ways. So what this is, I always like using the analogy. Your mom has a J.C. Penney card she's had since '85, which actually makes me sound old now. Um, but like you want a credit card that has, it's at least 5 years old. It's got little to no balance and no derogatory history, meaning has no late payments. And all the donor does, they basically call the number on the back of the credit card, and I mean sometimes they also do it on the app, but they'll go ahead and they'll give that creditor like your information. Sometimes they don't even ask for the social, but at least the date of birth and stuff. You get added as an authorized user, and there's really no risk to the donor because you're not getting a credit card that you can go spend. I mean, the how this started out was, your grandmother needs to get groceries, and you take her credit card to go buy groceries, and you can sign your name. I mean, that's basically how it started. But then, people started realizing it started helping out your credit score as well. And then, so that's a quick way to boost it. But then you have to, you can say you boost your credit, we get you into a house, and if you want, you can stay on that, or that family member was like, "Hey, I helped you out, but now I my peace of mind. I'd like to just take you off," and they can. Oh, or on the flip side, you can also remove yourself. Say, it's a Lowe's credit card, and the dishwasher went, and now they've used it, and now that's negatively impacting either your debt to income, because obviously whatever's on that for payment goes on to you. Or say say they suddenly, missed a payment or something, you can get that removed. So it doesn't stay, on you like your own credit score.
I did that with my daughter just because she moved to another state and just for emergencies. But I have full control. I can set her spending limits. I can freeze it so she can't use it at all. I didn't do it for the credit purpose. I did it, like you said, just for a more convenience method. But she checked her credit one day by one of those services, and she has a decent credit score. That does really work. It's a great tip.
Yeah, I mean, it help them on the right step of building credit. So then they can, now they're a little further ahead. They're not just trying to start at the bottom of getting credit. So if they already have a score, they're more apt to get their own credit cards and stuff. So they're in a better spot. Now, obviously, they are going to need to, depending on the loan program, have credit in their own name for say a period of 12 months for certain loan programs. Whereas others, as long as you get a score, that's all that matters.
But what you said, I think that it's important to note again, a trusted person. So it
Yeah.
shouldn't be somebody that, because it could hurt you if you get on somebody's credit card that is not timely in paying their credit card bills.
Right. Yeah. And also the same person, say there's a married couple going on a loan together. Um, that one person can add both of them on to the same credit card. So so you could help them both out. Because also, like I said, if we have two people on a loan, we're going to take the lower middle score. So say mom helps out her daughter, raises her credit, but then the husband still, nothing's really changed on his. It doesn't really help them out because they're still going on the lower score of the husband. So it's just also be aware that sometimes you can add the same person can add the same credit card to multiple people. And then like one of the other parts is like diversifying your credit mix. Again, this is another 10%. So this is basically just having different types, installment loans, credit cards, student loans. It's just, trying to have a better mix. Like, you don't want to have just like all loans and no revolving credit. You want to have kind of a mix. And again, kind of touched on some of this other stuff, keeping your accounts open, because that's 15%. So what happens with, say someone does a debt consolidation, it sounds great. Say they have $70,000 worth of debt, and you can have a lot of debt and actually still have a great credit score, because you're not maxed out, or you've got a diverse credit profile. But what will happen if you do this debt consolidation? Just be aware that you're going to tank your credit. Now, obviously, if you're just trying to get out and you need to, so your bills get reduced, that's totally acceptable. Just realize you're gonna, for the next few years, your credit's gonna go, because when you do the consolidation, a lot of times they have you stop paying. So like a part of them to negotiate with the creditor, now you've missed a payment. So sometimes you'll have, they get, say they're consolidating 10 credit cards. They potentially could have 10 lates. And then on top of that, once they do the negotiation and they pay it off, they close out all those accounts. So now you've lost all those accounts. So like I had a client a couple years ago, he was high sevens, and then he did the consolidation, and he was now like 589. So it's just stuff you have to be aware of when you're doing, if you do a consolidation, or just in general paying off your credit cards, you want to keep them open. And again, we touched upon, limiting your hard inquiries. Again, that's another 10%. So like with a mortgage, we're only going to pull your credit once. Obviously, let's it's a situation where you haven't bought it in 120 days, and now we have to re-pull your credit 'cause it's expired. However, be mindful if you're going to buy a car, every time they say, "Oh, we're going to check with, Capital, we're going to check with Capital One, we're going to check with, all these different companies." Every time they check to get you a better rate, they're also re-pulling your score. Like I've had times where people have legitimately had their score pulled up to 20 times to buy one automobile. So you want to be very cautious and maybe do some of your calls ahead of time, either your local bank or credit union, or just kind of see what their advertised rates are.
I want to take a minute on that. So you should be proactive to find out, are you pulling, is this a hard credit pull? And
Yep.
when you're sitting at the desk in the showroom and the finance guy goes back, he may be shopping for a rate, which sounds like a good thing, but all of those pulls could harm your credit. And
Yeah, and they're going to sit there for a while.
can you
And
talk to me
then
a little bit about, and you may have this on the list, but credit builder like loan programs? Like I know my credit union has a specific product that is called a credit builder loan.
there's a couple different ways. Like one, you can start out with a secured credit card. So how this works, it requires a refundable security deposit, typically $200 to $500, that acts as a credit limit. You use it like a regular credit card, and the payments get reported to the credit bureau. This will help you, establish credit. Just still think that it takes time for it to start building your credit. So basically, you're giving them money and then you're charging money on your own. So no one's really it's your own money. So with something like this, it's want to be below 10%. You want to pay on time and in full each month. And then you want to look for the secured cards with a graduation path to an unsecured card, meaning a regular credit card. Some of the better ones are they have like Discover It, secured credit card, Capital One Platinum, secured credit card, Chime Credit Builder Visa, and then obviously your local banks are going to have some stuff as well. And then you can also have your credit builder loans. It's kind of like your secured credit, but this is basically the lender holds a loan amount and a secured amount while you make your payments. It gets reported to the bureau, and at the end you receive the full loan amount. Yeah, and also like one of the big ones they've been marketing a lot is your Experian Boost or alternate credit reporting. Experian Boost allows you to add utility bills, phone bills, streaming services to your credit report. That's a way to helping increase stuff. Obviously, that only affects Experian. If the bills that you connect, make sure they're ones that are paid on time. Monitor your score to make sure for any changes. If something goes negatively, obviously remove it. Other ones are Ultra FICO and eCredible Lift, and obviously a Google search will help you find some more as well. And also the beauty about those are it's not going to affect your DTI. So your debt to income. So again, that's where your front end debt to income is the amount of money you make divided by your loan amount, and the back end is the amount of money you make divided by the loan amount and your existing debt. So say you're reporting $600 in between utilities, phone, everything else. We're going to exclude that because that's not real debt. Only stuff that we're going to use on debt is stuff that actually shows you in your credit card, like your secured loans, credit cards, mortgages, all that type of stuff. So it's a good way to help boost your score, and it's not going to negatively impact your debt to income because we can remove it. And then also, if like people that are renting, there's also rent report services. So on those, you want to make sure that these are ones that are being, reported to all the bureaus. So that's like Rent Track, Level Credit, Pinch Rent. So there are some options on that. And also, I mean, it does help. Earlier we touched about like looking at the whole credit profile. If somebody's got shows that they past 12 months they've paid their rent on time. So there's always other things that also can help you out. And then you getting your own credit cards. So like a store card or gas card, they're a lot easier to qualify for. This is something you're going to use for small purchases and pay off in full every month. But however, be cautious. These usually have high interest rates. With store cards, you also have to be aware, like say like a jewelry store or something. A lot of times, if you don't use the card in 12 months, they're going to cancel it. So you also have to be aware of that. And also, say you're getting engaged and you apply for their credit card. A lot of times, what happens, say it's a $5,000 ring, they're going to give you a card for $5,000. So you're automatically starting out maxed out, which is going to kill your credit. So, on stuff like that, be very, very wareful.
You really
So you
have to
just
educate yourself on how credit cards work because they can be your best friend in building credit and they can also be your downfall. So it all has to be thought through. You're bringing up so many great points.
Yeah, and a lot of times you just have to be aware of what you're comfortable with. Usually, if you can increase your credit, and same thing, you can even call your creditors and ask them to see if they'll increase your credit. Now, if they'll, but ask them if they're going to do a soft pull or hard pull. If they do a hard pull, then it's not worth it. But if they just say, they're going to do a soft pull, then by all means let them do that, because the higher you have, the better utilization. As long as you can trust yourself not to use it, because it starts out small. Oh, I just need to get gas, and then you do a couple more things, and then or you connect it to your Amazon account, which is even worse because you just click order, and next thing you realize I've spent $600 this month on Amazon.
Yeah, yeah. I'm as I'm thinking, it's all about self-restraint, responsibility, some maturity with using those things. And we have to take an honest look at ourselves saying, okay, can I be disciplined with this and can I trust myself? Because if the answer is no, let's look at some other methods of potentially building credit, not through credit cards or those types of credit situations that might get us into a little bit of trouble. So that
But if
actually brings us nicely into repairing credit. If your credit is tanked, and first I want to say Mark's not going to judge you. He understands life happens. There's death, divorce. Maybe we were never taught how to be responsible with credit, or we got ourselves into a situation that just was, like you said, a slippery slope. So they come to you and they're ready to get serious, and you do your soft pull, and it doesn't look good. What's your first step?
basically just try to see if there is stuff we can do. Usually there is, but like I said, if it's that one person that has 45 lates, that's going to be a little bit more difficult. If it's just something where, again, they had a something happened a couple years ago, and now we're just working on through that. And then also is like looking at collections. We're going to try to strategize how to pay off some of the stuff. Medical debt, we're going to pay off last because that doesn't affect your debt to income. If you have a collection to Verizon, you bought a new iPhone and then you switched or whatever, and you didn't like it, it's going to be 5% of the balance. So they're going to have to charge you on your DTI. What we can do to help repair this? If you had late payments, only time's going to fix late. So that's when we're going to look into, okay, can we get you on authorized users? Can we get you on Experian Boost? Stuff like that we can get you going. The one thing you absolutely do not want to have is late mortgage payments. That could basically potentially from prevent you from getting a mortgage.
What about somebody that's had a bankruptcy in their past recently or even 10, 15 years ago?
Yeah, so usually it's going to be 4 years. Again, it also depends on if they're Chapter 13 or Chapter 7. So if they've had a bankruptcy or foreclosure, it's going to depend on the loan program. The shortest is usually 2 years. We do have some non-QM products that actually we can get around certain things where they might not, bankruptcies isn't going to be an issue. So there are definitely some programs out there. It's just you're limiting what you can do. Usually a lot of times there is a product out there for somebody. It's just the more risk there is, the more cost is going to associate because they have to cover themselves in cases of defaults.
So I want to ask you about some myths around credit. So one of the first ones is if I co-sign for my son for his car and he doesn't make his payments, that's not going to affect my credit. True or false?
That's definitely false. That's going to impact your credit. And also the thing also you got to be aware of if you're signing on for student loans or any co-signing cars, anything for that debt, that if that also is on your credit. So when you go to say you need to go buy a new vehicle, you may not qualify because your debt's too high, or you finally this lake house you've been looking at for 20 years it's finally come up available, and now you might not be able to buy it because you co-signed.
All right, here's another one. Having unpaid payments or any kind of loan forbearance during COVID does not ding my credit because it was COVID.
Yeah, no. There's that was a huge issue we had. We're starting to come out of it. So places were in forbearance, and depending on the loan program, like you had to be out of forbearance for 3 months before you could even sell your house. I mean, there was stuff that we'd run into. They could sell it, but they'd have to sell their house, wait 3 months after the fact, because it had to be out of forbearance for 90 days, and then they could get a mortgage. So there's a lot of different things in, some of these stuff, like even in their student loans as well, would go into forbearance without them even saying anything. Like, it just automatically happened.
Yeah, I think that whole thing did a great disservice. There probably was a small category of people that needed that and that it helped, but it wasn't presented in a way that there are some possibly long-term effects or consequences from taking advantage of those. If you were up against it and you had to do it, then you deal with the consequences.
Yeah, and again, I think it was a situation where it was, it's all good intentions, but when you have stuff that you don't even know about and they're just doing it for you, like some people didn't even know, and then they think that, oh, my student loans are in forbearance, and all of a sudden it comes out, and all of a sudden now the payments are due, and now they're so used to not making the payment, all of a sudden now they've got late because they didn't realize they had to start paying on it.
Here's another one. I make a lot of money, so I must have a high credit score.
No, no, that's definitely false because I try to tell people like some realtors, be cautious when you see the person drive up, that's got a '87 F-150 all beat up and like, oh, I'm gonna waste my time. Or you get this other guy shows up with a 24 Audi. They could be, the other person could have great credit because they don't spend much. They pay their bills on time. They're not leveraged. And the person in the Audi could have like be, they make 100,000, but they spend 100,000. So you gotta be mindful of, there's no real until you get in there and look at the credit report, you have no idea what their spending habits really are.
My medical bills that have gone to collection will not ding my credit.
So that's a little bit different on that one. They don't really affect it that much. Like you want to, obviously pay them, but it's not going to affect your buying power.
Okay. I've been approved for my loan. My credit score was great. Now I can have a party. I can buy a car. I can buy furniture for my home. It doesn't matter. They've already checked my credit and I'm all good.
Yeah, no, definitely not. So within 10 days of closing, we're going to do a credit refresh, which is basically a soft pull. So what that's going to be is if you have any new inquiries, any lates. New inquiries, sometimes it could be something like RH Foster or somebody, you call them up you're buying a house and you're getting utilities set up. That's normal. We just signed something. Yeah, that was for this. I didn't take on any new debt. And then it gets into, yeah, I went and bought a bunch of furniture. Now we have to go ahead and, add that to your debt to income ratio, and now you might not qualify. Or you have a late, and now we have to actually re-pull your credit. But I mean that the big thing is, I mean that's they literally ask you right at closing, any new debt and stuff. So yeah, you don't want to buy that. Just wait till after. Once you close, go ahead and do whatever you want. But definitely don't do that because it can kill your deal.
I only have to check my credit score once a year.
No. So you can for free, you can check your credit at least 3 times for free. So you can because each bureau you can check. So every 4 months, check Experian, then TransUnion, then Equifax. Because also, then you're gonna be able to monitor, see what's going on. Because again, at any point somebody could have, there's always data breaches. So it's just definitely monitor your credit and stuff, and especially if you have any of those cards that have are tied to places with memberships, be aware.
I shouldn't go talk to a loan officer until my credit is great.
Yeah, that's definitely not because again, you're gonna say you're looking at Credit Karma. You only pull them 2 bureaus, and they could be the third bureau might be one that actually has something that hasn't fallen off yet. Um, and again, it's just knowledge is power. And if you don't know what you're taught, what your credit looks like, again, you could fix things. And a lot of times, yeah, there are houses I kind of like this house. It's not really the one I want. So you're just kind of looking, and then all of a sudden you're like, oh my God, this is the perfect house. And then you come and I'm like, yeah, I can fix your credit in like 3 months. Because basically whatever you do today is going to It's going to take 30 to 45 days because every creditor reports differently. Whatever you do today, it takes time.
I think that keeping your financial fitness at a baseline and being proactive, those are all great messages, and that a loan officer like yourself or most of them will work with you. And a lot of times, don't put your head in the sand because it may not be as bad as you think. And we have so much information coming at us constantly, financial advice, advice for credits, people that are trying to sell you products. But to really sit down with a real human being and talk about what your goals are and what your situation is
Yeah,
so
and
much
again,
better.
you might not be as bad off as you think you are.
I want to bring up the point too that we've talked about a lot of things, but we've mentioned, and you've mentioned, a lot of different services to help repair credit, boost credit, services that you can report, like your utility bills
Yeah.
and that sort of thing. And I just want to caution people to make sure that they're working with reputable companies. And I'm going to ask you for a list of reputable companies that you've worked with so I can put that on the website, because there are scams out there, and we just want to make sure everybody's protecting themselves and their
Yeah,
credit.
yeah, you definitely don't, it's like you're obviously like your Experian Boost and like your local credit unions and banks. Obviously, that's going to be your more secure places. It's when you do a Google search and all of a sudden you come across some random one, just do your checking. And they could even have, the Better Business Bureau logo or something, but anybody with Photoshop can throw that on a website. Be cautious on giving out your information.
Absolutely. So, what's our takeaway, Mark? If you had one message that you want our listener to take away from this episode, what would that be?
I think basically it's just be mindful of your credit. That is definitely not who you are, but on a snapshot, that's how you're going to be viewed for any loan or any purchase that you make. There's stuff that we can do to help you out, but ultimately that's going to be a lot of the stuff that's going to affect what you can buy. A bad credit score could cost you tens of thousands of dollars. Do whatever you can to help work on it. If you need help, reach out. We can sit down, Zoom, in person, over the phones, different things we can do. Just don't become an ostrich. Be proactive.
It's a long game for sure.
Yeah.
I'm going to share all the information along with your contact information on the website. What's the best way for people to reach out to you?
Email or phone number, so it's 207-478-2065. Text message is usually the quickest.
Well, I appreciate you coming back on and sharing all this information. I always learn something when we have a chat. Thanks, Mark.
All right, thank you.
You can find references and contact information for Mark Lloyd at MaineRealEstateRoundtable.com. Visit the show notes page. This has been the Maine Real Estate Roundtable podcast with Bobby Grenier. I hope you enjoyed today's discussion and will share this episode with a friend. And don't forget to leave a review and follow the podcast so you don't miss new episodes. The content of this podcast is for informational purposes and not intended as legal advice or representation by myself or any of the guests on the podcast. Thanks for listening, and until next time, keep it real.